we've seen Q2 GDP numbers just come through, coming in at 1.3% quarter on quarter, where consensus was for 1.6%. Your overall impressions of the numbers that have come through?
Well, we actually forecasted a slightly weaker number than the 1.3 that we saw. We were looking for 1% growth, which would have been quite weak. But the 1.3% is not impressive at all, but it is largely in line with anticipations. Where we saw the weakness was in agriculture and mining and manufacturing. So that is where the economy took a beating in the second quarter. Some of that was due to sort of your temporary shocks. We had the protracted automotive strike that certainly undermined large segments of the manufacturing sector. You also had trouble at some key steel furnaces that also affected manufacturing, and overall you had a weaker global economy that clearly impacted on exports and also dragged down production. So those industries were the worst affected. But if you then look across your sort of domestic trade and services industries, overall we have seen slower growth for most industries, with the exception of general government, where there was actually quite a strong pickup.
Of course, we've seen that kind of growth come through, and you've drilled down into things on a sector basis. What you've managed to read from these numbers, today, what does that in turn say about the IMF's, bullish view on growth moving forward, where just last week we saw revisions made to the upside, where initially the IMF had anticipated 3.5% growth for the year. They've revised that upwards to 4%. Are they being too bullish on that end?
I would say definitely, unless you have an incredible rebound in the second half of this year, which seems very unlikely. We already know that manufacturing is probably set for quite a protracted period of weakness, as we know that the trouble that Mattel is having with their Newcastle furnace is likely to affect steel production and the supply of steel into other manufacturing industries for another 3 months or so, and some are even anticipating that it will lay that industry bare up until the end of this year. So we know that manufacturing is going to remain weak. We also know that there isn't any signs of a convincing rebound in the world economy after a disappointing second quarter. So things are likely to remain slow, and it really therefore all comes down to the consumer. If the consumer finds new spirit and new enthusiasm and start to return to the stores in droves, maybe we could have a stronger growth rate, but it would take quite something to get to 4%. In fact, since the first quarter's numbers were also revised down slightly, we're now looking for only 3.2% growth this year.
Of course, lending to the status on the health of the South African consumer was data that we saw filter through earlier this morning. Credit growth for July coming in at 5.65% year on year. What does that indicate for you in terms of the health of the South African consumer at this stage?
I think they're quite fragile. I think they're certainly in more of a consolidation mode than in a spending mode. I certainly don't think it's the end of consumer spending, but they are definitely a little bit more cautious. You must know, since the beginning of the year, we have seen certain key cost items rise. We've seen quite a big jump in electricity cost. We've seen higher petrol and diesel prices. We are also slowly seeing food prices rise. So, the cost of those non-discretionary items have gone up. That's putting some pressure on income. And this consumer is still only spending in line with income growth. And that is clear in the credit numbers. As you look at today's credit numbers and you break it down, the big surge really came from the corporate side. It didn't come from the consumer side. So consumers really, if income is taking a bit strain, they cut back on spending. We saw that in the second quarter, and we're probably likely to see that softer trend continue during the remainder of this year.
Of course, that data comes hand in hand with data we've recently seen when it comes to insolvencies and liquidations that are recorded in South Africa. It's been decreasing, and according to Stats SA, the number of liquidations recorded for the 3 months ended July fell by 50.8% compared with the 3 months ended July 2010. So that's certainly encouraging in terms of the way debt and credit is being handled at this stage.
Yes, I think it's more responsible. It is more conservative. Yes, it is growth inhibiting, but at the same time, over an extended period of time, it is undoubtedly more sustainable.
Taking a look at where we're expected to see some recovery in the economy, let's drill down into manufacturing. With that manufacturing sector making up 16% of the economy, I mean, PMI we know has fallen to 44%. It's going to be difficult to get back up 50, but one would assume that one of the key data points that the markets will be looking out for from here on out?
Certainly, the odds seem to be stacked against the manufacturing sector. There's a couple of reasons for that. We've had in the third quarter another wave of strikes going through the industry, from your petroleum refineries even all the way through to your wholesalers. So that certainly will be a negative impact, will have a negative impact on the manufacturing sector. Then you still have those continued problems at the Newcastle furnace, steel furnace, and of course that's the primary steel furnace that provides steel to the rest of the manufacturing industry, so it hits manufacturing production directly, and then it also hits the rest of the pipeline indirectly. So that certainly will keep the third quarter weak. And really, if you're going to see a rebound, it's most likely to be in the final quarter of this year, and for that to happen, you really need the global economy to gain some traction.